All right,
Switch
throw me
my
top.
shit around.
No,
We're live.
Set me up. No,
chaos.
We're format.
Live.
Throw me in bottom right.
Aren't you bottom? Oh, okay. Gotcha.
There we go.
There you go.
Hello,
Tanner, go ahead. You hosted this time. Boom, you got it.
ladies and gentlemen. Welcome to Amit, Steven, Tanner, Chris, and Tevis's podcast of SoFi Weekly. Maybe being rebranded to
don't lock
FinTech
me in with
Weekly.
don't lock me in with you guys, bro. Come on, I'm a mercenary. Okay, I'm
He
here for
is-
the.
He
here for
is
the
a
return.
Look at
regular
this motherfucker.
now.
One of us now.
He got accepted by the community 3 days ago, and now he's ready to stab you in the fucking back.
No.
I dealt
Yeah.
with this. I dealt with this already.
No, I'm just saying this is your guys' show. Like, you guys built this yourself. As much as I want to be a part of it, the credit should go to you guys. Me, I'm just along for the ride now because I'm starting to see what you guys are doing. So, like a lot of times I had a lot of questions about SoFi. I'm generally a very skeptical person, but as I'm doing more research and deep diving in, I'm starting to see what you guys are seeing. That's all.
So, like I said, a regular here, Chris. He is he's one of us now. Bought the stock. So once you buy the stock, you're always welcome.
You need to sell those cowbells.
One day.
Yeah.
Just
But
like
does
with
he have
their
multiple?
face
Why did you
on
say
them.
cowbells?
I have 2 in my house. They're from Amazon. It's not like I custom ordered them or anything. It's funny because Chris hates it on Palantir Weekly and Tevis hates it on SoFi Weekly. So you both have mutual disdain for the cowbells. All right. Let's get the show on the road with the first question, most important question. Christopher Patel, you have made a purchase of SoFi. I'm actually going to pull up your tweet where you announced it to the world, went a little viral in the community. You have been the biggest skeptic / personality that is more bearish than not on the company, and that changed 3 days ago. What changed and why are you now a bull on SoFi?
So, one of the biggest concerns I've always had about SoFi was their personal loan book, right? Personal loans, to me, they're almost predatory. If you really look at the interest rates that get charged for personal loans, they're like almost double digits. Like, people looking to build wealth don't do it through personal loans. I understand that there are times where people could get into some credit card debt and then they end up consolidating using personal loans. But to be honest with you, not too many people that I know are in that position. What I have seen a lot is people using personal loans as bridge loans, and that's perfectly reasonable. But the rate at which they're paying is just nuts. So when I see a company go overly expansionary when it comes to personal loans, it worries me because it's one of those areas that, personal loans are unsecured debt. That's like there's nothing really backing these personal loans. At least with other types of loans, there's assets behind it, whether that be, houses or property or some sort of collateral. Personal loan is just me giving you money and hoping that I get that money back. And a lot of times they have to like juice up the interest rate so much because the amount of people that typically default on these personal loans is relatively high. And so as the economy starts to go down, those personal loans typically are a big nuisance on companies' balance sheets. But one of the things that really changed my mind is as I started to dig a lot more deeper into the client base that SoFi has, and what really like said it for me was the concept of a Henry. And I'm not sure who coined it, but I heard it mentioned on SoFi Weekly first. So then I really started to dig deep into that Henry concept. And I think that's what really changed my mind because I work with a lot of individuals who...
Chris, you should explain what a Henry is.
So a Henry is a high earner, but what is that?
Not rich yet.
Not rich yet, yeah. So it's people like your doctors, your nurses, people who work in certain fields where they just have a lot of income, but at the same time their expenses are up there also. So I was watching How to Become a Millionaire or How to Become Rich on Netflix, and what I saw was majority of the people on there, they had some form of personal loans, but if you look at their income, it was really high income, right? So I think we are in a society where personal finance isn't necessarily taught as much. And I need to dial back my pessimism when it comes to personal loans because I feel like personal loans, as long as you have good credit quality borrowers, they'll be fine. And as long as you are actually adjusting your rate of return to allow for a certain level of defaulting, you should be fine. And yeah, after I did research on that, I really did a deep dive on Anthony Noto and the management team. And these are former Goldman bankers. These are guys with Harvard MBAs. Like, they know what's going on. These are not like your run of the mill, just went to some junior college somewhere and decided one day, hey, let's do a electronic bank. Like, these guys are killers. And as I deep dive into their pedigrees, but also their experience, they come from large banking experience, which means that they have the ability to scale up and bring that same level of knowledge to the SoFi community. And so as I
Let me
did more
step in real
research on
quick.
that-
The stock
yeah.
dropped to 440 on Monday. Did that have anything to do with you looking even deeper to establish a position?
Yeah, I think in general, I think financials are very undervalued right now. Majority of them are trading under book value. Their PEs have dropped off significantly. So right now, financials are a big interest to me. And as I look through SoFi, at $4 and something, the risk premium is on your side. Like, there's not really much downside you can go after this. So it's one thing if SoFi was trading at $20 and you're asking me, hey, Chris, can you risk some money on SoFi? Probably wouldn't make sense to me. But at $4, at a $4 billion market cap with assets that are in the $15-20 billion with liabilities that are manageable, and at the same time, you have a depositor base that's getting bigger and bigger. And after that, I just thought strategically too, like, what is Anthony Noto doing right now? And I think their sacrifice, like, I think Noto and team could literally do profitability like this. Okay. They can just snap their fingers and become profitable overnight, but they choose not to. And the reason why they're choosing not to is they are going after as much market share from the traditional banks as possible. So they are eating the short-term pain, because right now, people are in the like, not, I don't want to trust my bank mode. They want to get as many people on their platforms as possible, because people are creatures of habit. And once you get them into your ecosystem, it's really hard to get people to switch out. Like me, I've had TD Bank for the last 20 years. TD Bank treats me like shit. All right, barely get any interest. But you know why I stay with them? Because I'm too lazy to switch all my auto payments and everything. And I'm like, yeah, I'll get to it next Tuesday and blah, blah, blah. But here's the thing. If I end up signing up with SoFi, I'm probably going to be a member of SoFi for the next 30, 40 years. So I just think that right now they are in growth mode. They're willing to sacrifice short-term profitability to get there. They don't have the footprint, like the capital footprint that the other banks do. They also don't do a dividend. That's the other thing. All these other banks, they have dividends that they have to pay their investors. If they don't pay their dividends, investors will dump their shares. SoFi doesn't have to pay a dividend. They're fine right now in growth mode. So I just think this is, honestly, at this point, SoFi at this price, just, it's a no-brainer. It's like, to me right now, it's just an easy double without even like trying. And the comments that I saw that's Anthony Noto made in the last quarterly call, they were very, very specific. And I think once they hit GAAP profitability by the end of the year, which is what their target is,
The sucker's going to run.
You're going to see a very similar growth. You're going to see a similar thing happen with Palantir. So Palantir was all about, hey, this is a failing software company. It's not growing X, Y, and Z. But the minute they turned on the spigots of profitability, everyone and their mother started jumping in, including other funds and everything. So I think this is a very similar thing that's going to happen, where Q4 comes, they show profitability, net income, GAAP profitable. They're going to have a PE. PE is going to be high, but you're still going to have a positive PE, which means a lot of companies a lot of funds are now going to be willing to put money into them. And by that time, they'll have captured a good amount of market share too. So yeah, I think they're setting themselves up for a very strong 2024. It's just in the 2023 time, you're just going to have to be accepting of some of this short-term pain. That's all.
So Chris, let me ask you this now. Now that you bought, and also to cap that segment, I'm curious. You've obviously thought, with your meta call and stuff about what your exit is going to be. Is this something that you want to just double up right out in the fairly short term, hold long term? Like, what's the strategy there?
To be honest with you, I think this is a long-term play for me. As much as, I mean, is there a price where if it runs too quickly, I will sell a little bit? Yeah. If it goes up tomorrow and 80%, yeah, you should be smart and say, let me take some money off the top of the table. So this way I have enough when it does pull back after a short run. I have enough, optionality to get back in. But if it's a slow, steady grind higher, I think this is one of those companies that I wouldn't mind holding for 20 years. And I think they have the ability to be a JP Morgan after really deep diving into. I mean, you guys see this as some kind of like fintech. I see it as a bank. All right. I value this thing like a bank, but they're an excellent bank. That's the point. I think you guys are really bullish on the technology, which
So Galileo didn't play a role in your due diligence
no,
at all?
no.
No,
I mean,
not at all?
it's
That
know
was
what?
my
It's-
reason for buying in the first place.
That's fine. That means you get it for free.
yeah, exactly. It's just a cherry on top. It's a cherry on top. Yeah. I would think, look, just take your hat off with the whole fintech thing. Just take that off for 2 seconds. Think of it as this is a bank. What do banks do? They borrow short, they lend long. These guys have all this money coming in short term at cheap capital rates. They're literally paying 4%. If you go to any bank right now, go to FINRA's website and look at how much they're paying on their debt. It's 7, 8, 9% on their long-term debt that they've issued. Okay. SoFi right now, because of their captive audience, they're getting all this extra money at 4%. They're going to be lending money to other people at 7, 8, 9% and make a killing on the spread. They're going to have these longer term loans that, by the way, once interest rates start going down, those loans become really valuable. There's going to be way more value in them. So, and they make money on origination. So you're going to have a ton of non-interest income coming in also. I'm telling you, 2024 will be the year that you'll see SoFi really shine, and people are going to say, how the hell did I miss this?
Right.
But that's my own personal due diligence. That's what I think.
I've never heard anything that made me blush as much as that. I mean, geez, that was the entire.
I just had a
case.
fucking orgasm.
Yeah, no, Jesus. I mean, from start to finish, exactly how I think we've tried to pitch it, and yeah, that was really cool to listen to. From not the biggest bear. Everyone likes to call him a bear. He's the biggest critic. I think is a better thing. There was this comment though under your tweet, Chris, that I thought was super important. Actually, can I share my screen? Just to let everyone read it, because I thought this was really, really important and something that I hope that we all stick to here. It says, I hope you guys stay true to your individual investing principles and don't succumb to groupthink. Someone telling you to buy something weekly and week out, or week in and week out, can create a powerful echo chamber that makes someone reinforce each other's good and bad ideas. So what do you think about that? Are you really do you think that you've overanalyzed this company or are looking at maybe not as much of the bad sides of the company, due to not as many people giving you the opposite side of the argument here?
Well, the thing is, whenever I look at a company, I don't try to go in with an optimistic view, right? I start off with, how is this company going to fail? Like, if you start off negative, you actually get a lot more out of that. So even if I'm looking at Google, I'm like, where are all the points where Google is going to fail? At which points will Meta fail? And that's where you realize that, hey, wait a second, I don't see nearly the amount of things that could be vulnerability. Like, as much as right now we're looking at the total delinquencies, like delinquency rates on SoFi, they actually went up. They went up to like almost 4% on their personal loans, but it's well within their modeling that they have. They're still able to generate a shit ton of money to cover those very easily. And on top of it, they have a lot of non-interest income that's going to be coming in because they're providing just so many services. Like, I was looking at something like their ETF. Their ETF is relatively small, but it tracks it's in line with the S&P 500. You guys know what it is, like the SFY, right?
Sure.
You guys know what I'm talking about? It's like the ETF.
They've got a bunch of them, but
yeah, they have a
right?
weekly
Now,
dividend one. They have a bunch.
Yeah. Now, the thing is, like, that is a very small business right now. It's something that no one really even considers. But once you're in the SoFi ecosystem, you look at the management fees. It actually makes more sense to buy that than to buy VTI. And it gives you this. Yeah.
If I'm not mistaken, I don't think there is a management fee if you're a SoFi member.
No, there isn't. That's the point, that people who are typically long-term traditional investors, they can put their money with Vanguard and VTI, or they could put it with SoFi, right? But it's all under the SoFi umbrella. The performance fee, by the way, there is a performance fee, but it's really negligible. The difference is that the assets under management right now are not really up there. But over time, those assets under management are going to grow, and those assets under management will end up yielding a fee that's going to be coming into the SoFi ecosystem, right? And that's the way that I would think of it. SoFi is not a river. It's like a whole bunch of streams leading into the ocean. So that's I just, like I said, I see over time all those streams just piling in, and eventually it'll be a giant body of water that'll challenge the JP Morgans of the world and the Goldmans of the world.
Yeah, great highlight.
So,
Steve,
I-
actually, yeah, Steve, you go ahead, then we'll do this question. Go ahead. You got it.
yeah, I want to expand on what Chris said, because I've said this on one of the articles, but for me, it's not about today, because look, I'm not using SoFi as my primary bank. Like Chris said, it's a bitch to move everything around and whatnot, but it's who's going to have the best flywheel and mousetrap in the future. Gen Z is 97 to 2012. Okay. Bank of America, their research is showing that Gen Z's income will reach 33 trillion and surpass millennials in 2031. Since the end of 2020, Gen Z has been on track to increase its income from 7 trillion to 17 trillion by 2025. I'm not SoFi's demographic. That's SoFi's demographic. And
I don't even really think so. I think millennial is the demographic. I think, like, I am technically Gen Z, first year, like 97.
it is
I think that's too young personally. Like I would just be getting there.
Critical success factors. Their critical success factor is grabbing as many people as they can entering the workforce, getting out of college. That's sweet spot, because they have a huge trajectory of growth. And younger people, they want everything seamless transaction, and they want everything in one place, like Chris said. They don't want everything parceled out. They don't want to have to go to multiple things. We are a society of instant gratification now. And that's been part of my thesis the whole time, that I do think SoFi has developed the best ecosystem over the past 2 years, because they were forced to adapt. And when you see a management team that can have their largest line of business taken away from them at a moment's notice and pivot and do everything else, I don't want to say flawlessly, but very well, to make it where they continuously increase their guidance, it's just telling of the management company and how the membership values its products. I think there's a long flywheel of growth there.
Right. I have so many questions. Maybe we should bring up that Johnny Mac comment, though.
Yeah, you want to read it out loud, Tanner, and then Chris can answer?
Yeah, Chris, are you concerned at all with the weakening job market increasing defaults on loans? I know you said 4% is current, but that could easily increase rather quickly in this macro environment.
So, unfortunately, I don't think we are going to see the level of unemployment that a lot of people are thinking. Like, you're already starting
4.5. We're not doing 4.5%.
No, I think the whole point of this whole inflation cycle, the whole thing of getting us into a recession was to control inflation. But the end goal is not, hey, we need to get 5% of the population unemployed, because that right there, it's bad. Like, you don't want to hurt people. Like, I know that is one of those things that you could do, but I think inflation is coming down so fast, so rapidly right now, that you don't necessarily need that many people to be unemployed. The labor market is just really, really strong. And I don't think that, I do think that there's going to be some material weakness, but not enough. And the credit quality of SoFi's borrowers speaks for itself. And that's going to be their biggest moat. I think a lot of times you have people like Lending Club and all these other ones, they're bottom feeding, right? They're like, we will give loans to a lot of people, whether or not they deserve it or not. SoFi is specifically targeting certain career paths that are insulated from recessions. Like, healthcare workers is like one of the areas where I think that they have specifically geared a lot of their members towards, right? My wife, she's a healthcare worker. She's a pharmacist. And when we first got our mortgage for our condo, my wife has loans. She's got 190,000 student loans. But SoFi didn't look at that and say, oh, that's a big negative. They said, no, you know what? You make all this extra money because you work in healthcare. You can very well pay your money and also do your mortgage. So we actually had a SoFi mortgage for I think like 5 years until we refinanced. And then Rocket Mortgage got screwed over by me because I ended up getting a nice 2.75% 30-year. And they call me every like other month right now. Do you want to refinance? Like, nope. You suckers made the suckers bet I'm going to profit off of you because I took that same money, put it in the market, and I'm getting close to 20% on that money right now, IRR. So sucks to be you, Rocket Mortgage.
Well, it also makes sense, just interesting timing on the trade, right? Or at least on the buy for SoFi, because we got the most accurate numbers in Q1. We know that the Fed isn't going to raise anymore, and we can get a more accurate landscape of what is it, like how bad is this going to look 6 months or 12 months down the line to a certain degree. And the cherry on top is SoFi is trading at, all-time lows, and just it seems like the juice is worth the squeeze at this point.
The only pushback against that is based on Powell's comments today. Now investors are pricing like a 39% chance that we do get 25 basis points. So I don't know how sure we are. Also, Noto and team thinks there's going to be 2 rate cuts by the end of the year. Look, I want to believe them, but I don't know if that's happening either.
No, the bond market's already telling you that that's in the works. Like there's no way around it. I think today was, and this happened to all the financials. It wasn't Powell. I was paying attention to Powell when I should have been paying attention to goddamn Yellen. Yellen is the one that screwed us over today. I'll show you guys. Let me share my screen real quick. Here we go. Can you guys see that? So yesterday, Yellen had a meeting with a whole bunch of the bankers, JP Morgans of the world, Jamie Dimons and everyone. And basically she said, hey guys, maybe you guys better be ready because there may be some more bank mergers coming, which means that there might be some weakness that's going to show up at some of the other regional banks. So all the regional banks all at the same time, and especially financials, now that we're always buying indexes, they all collapsed at the same time. The thing that you have to look at is the companies that are that relatively strong, like TFC, which is Truist. You see how after the comments they started to make a recovery, because the thing is, a lot of smart money, they were buying in. They were waiting for shit like this to happen, where people are paper handing and selling out of their positions so that this way they could load up. So if you look at US Bank Corp, same thing. They started a small recovery. Zion, I think, also did the same thing. Yeah, see, Zion almost recovered the entire way. So these are the kinds of things that just be on the lookout for, where I think a lot of what the Fed says and what they actually mean are 2 different things. Like whenever I see Jerome Powell sometimes come out, I'm just like, bro, you're a liar. You're such a liar, man. Because I know why. Because the economic data that's coming out is actually showing you that inflation is coming down significantly. Whether you're looking at it from a core PCE perspective or just a general top line CPI, it's just, I think financials over the next 2-3 years are going to do exceptionally well. I wouldn't be scared of the short term. I'd just be heavily diversified in my regional bank portfolio. But more than that, I'd look at the companies that are going to benefit from the fallout of the regionals, which is SoFi.
Sure. Yeah.
Okay.
Yeah. No, I'm super positive right now. I think that it's so funny because everyone was talking on Twitter like, yeah, finally he came in, but it's like, no, we're actually the dumb ones for holding this position on the way down. You're buying it at, well, I can't say it's a perceived bottom. Who knows? It could continue to go down, but at a much better price than what I'm holding it at, right? And this is just what Chris does. I even called it. I called it in the SoFi Weekly right before this one. I said, I think Chris is gonna buy. So funny. This man will change his mind. He'll completely change it up. I seen it on the Palantir Weekly, and here it is on the SoFi Weekly. This man is a bull.
I didn't know, by the way. I know people know me and Chris are close and all this stuff. But as soon as he tweeted it, that's when he sent me the screenshot of his position, and I was like, "Oh, I didn't know you were actually really thinking of it." So
I didn't know anything. Chris and I barely talk about anything other than new.
That's true. We were talking about Nubank last week. Yeah. All right. Do you have another topic, Tevis, or do you want to? Sorry, Tanner, or do you want to move on to some other fintech stuff, or do we have other SoFi stuff first?
We have a couple of things. I mean, there was a bunch of analysts. I don't know if we covered this on last earnings call. Maybe I can show you guys.
The $2 price target was this week or last week?
This
it
week.
was on the 14th.
That's what fucked the price, right? Okay, so we should talk about it then.
It was like on Monday, wasn't it?
It was on.
Oh,
it was
right.
on the 14th.
You're right. It was on Monday.
Yeah. here, can I share my screen? I just have all the analyst data from the people that have, changed their outcome or outlook since the earnings. So you guys can see here, and maybe I can highlight it for you and everything.
Is this on Notion?
Yep.
Oh wow, this is
Everything
very
I do is on Notion.
Yeah,
So
whenever the IPO for Notion comes out, I highly recommend y'all buy it.
Notion's great. Notion's
Yeah.
great.
I truly don't know how they make money. I mean, like
No,
they offer
enterprise,
so
at the
much for
enterprise
free. It's
level.
insane.
But it's you know what it is when you're a growth company, you offer it for free, but you charge the enterprise, and the enterprise are the ones where you actually make the money, not at the consumer level. Like Tableau, you and I can use it for free, but if you want to use the enterprise version, you got to pay Salesforce like a good amount of money. So
Sure. So yeah, what are we looking at here? So all of the things since what's called the Q1 earnings, you can see that the person with the lowest analyst rating. Now, this is actually something that people have been kind of bagging on. Is David actually used to be an amazing analyst? He was a 5 out of 5 star. He's had a very bad track record since like 2022. So he actually does have a very good track record since then. But
Wait, hold on. So he was getting stocks right in the biggest bubble of the past decade.
Correct.
So maybe he wasn't the best analyst then, right?
No, I'm not saying he's the best. I'm not saying he's the best analyst. I'm saying people are dogging on him because of his rating right now. And if you look at everyone else has a better rating than him on this list. 5 out of 5 stars, 3 out of 5, 2 out of 5. Dan Dolev, or Dolev, however you want to say it, is who Chris said should be the SoFi hero. Putting a $9 price target on this stock gave a really good reasoning for it, but also he doesn't have a very good analyst rating. No one wanted to talk about that either, but still higher than David's.
The thing with David is that there was some things in his note that were just factually incorrect, and if you spent a level deeper of research, they would realize that. I mean,
like what though?
Like with regards to, hold on, I'll pull up his note. But just in general, with regards to his note, I mean, I think Chris Hager just broke out his note.
He was wrong about the loophole. He was wrong about the loophole.
Yeah, there was a couple of things. There was like 5 or 6 things that were just wrong, and like the wildest stretches that you can make in terms of the risk in general. And so it just, that's the thing that rubs me off the wrong way. It's like, if people on just Reddit and Twitter can do deeper dives than these analysts, then I don't know. It doesn't make sense that they should have this much power over that stock price, especially considering the fact that on Friday, when Andrew Jeffrey initiated the stock, versus on Monday when this guy downgraded the stock, there was a completely disproportional response.
Yeah, I mean, one of the things that Dan Dolev said that the analyst had, or David had said, was that they wanted to, or they might need to switch from a held for sale to held for investment. And then I read David's article, and it literally says word for word, I am not saying they're going to, like, he specifically says what Dan said, or opposite of what Dan said he said. So I was just like, I didn't read Chris's article, but just out of the video that I saw from Dan Dolev, he said something that David said, and it never happened. So I was kind of like defending him a little bit. Now, I'm not saying that I agree with a $2.50 price target, but I just want to make sure that everyone's facts are straight, because it was a little bit weird. Like, I don't know. Regardless, like you can see at the bottom here, the average price or analyst price target. Now, I don't put a lot of weight on analysts, but still, it is good to know that people's full-time jobs covering this stock and a myriad of other positions are putting this price target at $7.25.
Steven, what is your price target for SoFi? The highest we had was $9. Do you have a different opinion?
What time frame are they looking at?
12 months.
Well, Chris kind of put a $10 price target on it here. He said it's an easy double.
I don't know. Those student loans have a lot to do with it, because if they do come back, which I am not saying they are, because I don't believe anything when it comes to it. It's been over 3 years.
They're
I
definitely coming
think
back.
SoFi is going to heat up if they come back and it starts back up in 2023 rather than 2024. So that could play a factor in the next 12-month price. I don't know. It's difficult. My view is 5 to 10 years of where I think it's going to be. And I'll say it right now. I think it's going to be 100 billion market cap in the next 10 years.
So it's a 20x to you.
That's like double his his last price target. I think you said whenever it was 6 billion, you said it was a 10x. I'll
I
take
don't know if
100.
we said 10 years out, but look, I think that I have no reason to doubt that they can't become a top 10 financial institution in the US. And if they do, it should put their market cap somewhere in that neighborhood.
That is fair.
Just remember, you guys have a former Goldman banker running your thing. All right. He grew up under the leadership of Lloyd Blankenfein. Lloyd Blankenfein was a goddamn shark. In order to
You look at
survive
their
at
board?
huh?
You look at their board.
Yeah, man. The entire board is stacked with freaking killers. Like that is in terms of like a team, you could not craft a better team of people to run a bank for growth and for profitability. Like it's loaded with a bunch of goddamn killers. Like
You have
I would
think
not
you
want to
have
be
the
on their
ex
side.
COO of Goldman on their board.
Yeah, trust me. Their pedigree of their board members is just nuts. Like they have a strategy to take it all. Like I'm more bullish on SoFi than I am on Palantir. I'll be honest. I like Palantir. No, stop. Don't do that. Don't.
Yeah, I
don't.
don't know if I do
I'm
that
not
because
gonna get.
Chris likes Snowflake better than Palantir.
I do like
possibly.
Snowflake. I do like Snowflake
So-
because that's because they have Frank Slootman.
Oh my
Yeah,
God.
I know. We've discussed that.
But the point is, they have a leadership team that knows how to execute, that has management experience in dealing and navigating rough waters. Like if you had a bullshit CEO at SoFi, I wouldn't touch it. I'd be like, that's too speculative. But if you guys know that if you have an operator who knows how to run a business and not only like run it at like a small level, but run it at the investment banking level, you're gonna be on another level of profitability. And I think by next year, you guys will be saying like, wow, that was the moment. Chris came in, the Uber bear came in and just basically, just laid it out for us. Well, don't believe in me, believe in the management team and believe in the ex-Goldman investment banker putting his own money on the line to buy as many shares as possible. Okay. Goldman Sachs. Yeah. Yeah.
Is your position fully built out right now, or are you looking to buy more? Like what?
I will probably buy more. I'm probably going to be adding throughout the course of the year. Right now, like I said, I think financials overall are very undervalued. Even if, let's say, SoFi just performs normally and financials all start to ride up, they'll enjoy the ride higher as well.
And what would be the 1 to 2 catalysts in the next 6 months that make financials rise up?
Lower interest rates. The minute they start lowering interest rates, all the assets that's sitting on everyone's balance sheet that they've marked down fair value automatically get marked back up. And then your price to book value makes absolutely no sense. Then your risk-free adjusted, like right now, every bank is, who their biggest competitor is? Every single bank's biggest competitor. Tell me, who do you think it is?
Sorry, say that again.
Who's every single bank's biggest competitor right now?
No, the treasuries.
Fed.
Exactly. It's the fucking treasury. Right now, if you're getting a risk-free 5.25%,
I'm guilty.
that would suck. Like to compete against fucking Uncle Sam right now. That's who you're competing against. But the minute Uncle Sam says, hey, listen, I'm putting my hands up, I'm lowering interest rates, all that money is going to be rushing back into the banks, trying to get higher rates of return, trying to put more money into different investment vehicles that yield them a higher return.
V says you're full of shit.
I am probably full of shit. But
No, he says interest rates are not going to zero.
About interest rates going to zero.
You don't need them to
look
go
at
to
like this.
zero. You don't
You have
need
to look at
interest
it like
rates to
this.
go to zero.
I put a significant amount of money in a 3-month CD because I was getting APY of I would have to ask my wife. I think it was like 4.4 or 4.5%.
Wow.
But that's crazy percentage for zero risk.
Granted, Robinhood at
Zero.
4.65, so you were kind of stupid on that.
Yeah, I'm not giving Robinhood any money. Sorry.
That's okay. I'm just saying.
You
An
could use
insane
SoFi.
amount of risk
and
It was,
comparatively.
just-
no, it's
and just-
250, 2 million FDIC insured. There's no risk. You didn't put
And
2 million.
also don't forget, if depending on what your income tax bracket is, the treasury is giving you that money tax free. It's tax free return, right?
On
Whereas
the
if you
federal
go
level.
on the federal level, it's tax free return, which is amazing because if you're at like me, I'm in one of the highest tax brackets. I'm paying up the wazoo for taxes, so I would need to make a risk free adjusted return of almost 8% to make an investment worthwhile, right? So even with the Fed giving 5.5%, you would have to literally juice your rate of return to almost 8% for me to be interested and make the same amount of return. And I'd have to probably take more risks. So instead, where am I going to park my money? I'm going to park it in treasuries. I'm going to park it in CDs. My father-in-law, I asked him like, hey, I was talking to him about it. I was like, hey, maybe it's time to buy some banks. I was telling him about Truist. He's like, sorry, man. I put a lot of my money into CDs at one of my regional banks that he uses. Like he's got a long relationship with. So that's what you're competing against right now. But the minute those interest rates start coming down, bro, SoFi is going to hit another level of profitability, and Noto's planning exactly for that. So you heard it here first. Chris is just saying interest rates go down, SoFi goes up.
You need them at 2.5%, 3%.
And then also a pivot to home loans and student loans as well. Help diversify the lending portfolio.
And when rates go down, this new acquisition is going to look real good after it gets fully integrated and broken out. Because now you're going to have the housing market start to heat up because people aren't, look, right now, people are not leaving a 2.5% to 3.5% mortgage to go take a mortgage at 6.5%, 7%. It's just not happening unless you have to move.
Yeah.
Yes.
That's fair. That is fair. All right. Do we want to move on to the biggest fintech of this week and its collapse, PayPal? Do a little discussion on them.
I would say I'm doing a lot of deep dive. I don't know if you guys heard of FedNow. Have you guys heard of that?
Yeah.
Go ahead, Tanner. You tell these people what FedNow is and how scary that shit should be for PayPal.
I honestly, I'm not too worried about FedNow and PayPal. I mean, they can integrate it with their own solutions, and they can offer other products like lending services and stuff. But pretty much what FedNow is a direct bank-to-bank solution for payments, 24/7, 365, no fees, but
No, they have fees. They're just really, really low fees compared to the clearing fees that you're going to be paying at MasterCard, Visa, and all these other.
Well, they're not
things, yeah.
they're not doing it for profit. You know what I mean? So, I think I'm a believer that I was reading a lot of these large banks might not even take FedNow. Like it's a opt-in solution that a lot of them don't need to actually use. So I don't know how fast it'll actually break into the banking markets. And then even in that case, I mean, I don't necessarily believe that PayPal will be 100%, destroyed because of FedNow.
If you can make direct payments without the need for an intermediary, which is what PayPal is, how wouldn't that disrupt them?
Yeah, but
it's all backed by the Fed, right? Like it's all secure, and there's a level of trust there as well. And you have lower fees, and you have faster transactions, and you don't need an intermediary.
I don't think that's PayPal's large business anymore. I think it's checkout. I think it's all these things. I think that there's a lot of services like their lending services and them to offer a bunch of integrations with large institutions. I mean, that's a lot of their moat right now. FedNow works in America. Like who's going to be making payments in or outside of China other than with the need with PayPal? So I'm not 100% believer that it's a massive disruptor. I think it's the reason why the stock is still holding up a value stock valuation, which I think is what it should be. If people are worried about, the brand dying or something like this is what people are valuing. But I just think it'll, grow past that. Very
Chris,
similar
why?
to what Chris is
Yeah, I was going to ask Chris.
for Meta.
Chris, why are you worried about FedNow in the context of PayPal?
Because it limits other people's upside. Even though maybe somehow Visa, MasterCard, they figure out a way to compete against all the positives that Tevis just told us, because that's what it is, it still affects their growth, because now there's something that's competing against it. And so what tends to happen is, if someone comes in and sets the trend of lower rates, people have to follow suit, and they have to actually lower down their margins just to compete. So
yeah, but I think that's happening in every industry. Like, that's happening with SoFi, with all their competitors raising rates, Apple coming into the business. You look at, Tevis just printed in our group chat, and a lot of these governments are actually limiting interchange fees, which is hurting Visa, MasterCard, all these. Like, this is the total addressable market for global payments is going up at an extreme rate. Yeah. Like, I do think that there's a market for it, and who better than a company with 433 million customers?
We get disconnected.
Nope. No, you're good. You're there.
Okay.
Yeah, no, I'm just I'm a believer in the stock. I think that I think FedNow is this big boogeyman that I don't actually think will be rolled out as quick as people think, and I think it'll be a long while before, if it even does hurt PayPal. I'm still a believer. Yeah. I think they'll be able to actually integrate it into their solutions rather than fight against it.
Steve, you wrote an article on PayPal. Any thoughts on the overarching bull case for this company at this valuation?
I'm pretty bullish on the current market cap. I'm planning on starting my position next week on it. I mean, it trades at 13.38 price to free cash flow, which is super low.
Can you before you keep going, you use the stat a lot and you've explained it to me, but for people in the chat as well, what is price to free cash flow, and why is that a good metric why is that your favorite metric to value a company?
Yeah, I mean, not going to say it's a good metric, but it is my favorite metric to look at, because free cash flow is the hardest profitability line to manipulate, because it is cash in minus cash out, no income tax, no write downs, no nothing. So net income can change, have a huge variable based on any type of charges against the income. Now, price to free cash flow is simply market cap divided by the free cash flow in the trailing 12 months is what I use. Something like a Pfizer, which has had a massive drop off, I would take an average of 5 or 10 years. But for PayPal, it's been pretty steady. Their free cash flow in the trailing 12 months is $5 billion. Okay, so the reason I use this plus equity is because, God forbid, the worst happens and you end up in Chapter 11. Assets minus liabilities is your total equity on the books. That's what shareholders are left with in court. So that's my baseline. Then I take the multiple of a peer group of free cash flow. So when I put these companies together, it was FinServ, Aiden, Block, Fidelity National Information Technology, Global Payments, and PayPal. Block, which is Square, trades at 449x its free cash flow right now, which is freaking crazy for any company, crazy. But anyway, I excluded them in the peer group average. So without Square's crazy price to free cash flow, the peer group average is 16.6x. So right off the bat, PayPal is trading under the peer group average. And when I add the peer group average multiple to their free cash flow, it's 84.73 billion. Then I add the 19.85 billion in total equity, and I come up with my baseline of what I think the company is worth, 104 billion. Their market cap's 68 billion. There's a 36.6 billion differential. Trades at 35% discount. Shares have to go up 52% to get there. So, not saying it's correct. It's how I establish a baseline to see if I want to do more due diligence into the stock and think things are going to stay steady or not. I mean, look, I'm fine buying a business that has minimal growth aspects if it's going to keep churning out that amount of free cash flow, because you can do buybacks. And what happens when you buy back shares? You decrease the float, increase EPS if the income from operations stays the same or increases. I mean, this is a company where the analysts, not me, but if somebody brings up Seeking Alpha and goes to earnings, you'll see the analyst charts on this. They're expecting huge amounts of increases for their EPS.
Can
And
you
I'm going to bring it up right now.
can what's his name? Amit, can you share this? This is from Steven's article, just going over
Since 2017.
Sorry?
No, I'm just saying since 2017. Yeah.
Yeah. Growth since 2017. This is what the company has done. A lot of this is directly in 2020 due to COVID. But still, no matter how you want to evaluate your stocks, like whether it's free cash flow or any way you want to spin this company, it has done amazing growth, and it's being priced as if it's going to be growing or not even growing. I mean, just staying stagnant and paying out investors. But I think it's not only going to be paying out investors, with large share buybacks, but also being able to grow, because just the total addressable market for digital wallets and everything like this. And this is not even factoring in if central bank digital currencies or something are coming out, which I guarantee you PayPal will be a big player in hosting a lot of that money.
So Tanner, think about this too. PayPal's consensus estimate, you have 41 analysts saying that the 2023 EPS estimate is $4.94. Then in 2024, you have 43 analysts saying it's going to be $5.68. And then the 2025 EPS, $6.46 from 16 analysts. I mean, that places the forward PE out to 2025 under 10. I mean, it's from a valuation standpoint, it makes sense. I don't know what the future is going to hold. Maybe their business crashes. I'd have to reevaluate. But right now, based on the numbers, this is a value play to me.
You're preaching to the converted. I'm a big fan. I'm a big fan. And not because I think that PayPal is the hottest growth stock, but at this valuation, I think it's just people think that this is a dead company, and I don't agree.
Can't be a dead company when you're generating $5 billion of free cash flow. That's not a dead company.
I agree. And people that do use the app are using it more and more and more. Like Chris said with his bank, why doesn't he leave TD? He's got all these bill payments set up and everything along these lines. Well, PayPal knows how to create sticky customers, and they continue to give large incentives for people to pay their bills through this. Do all these different actions that make a very sticky customer. And you can see since the beginning of time, the earliest quarterly breakdowns that I've seen, which are 2017, right? They've always increased their average engagement per user. Sorry, I'm stuttering over my words today. But
can you guys believe 2 years ago this was a $300 stock?
And that's the other thing.
I'm not saying it's worth that. There was a big mistake. No,
but think about the psychology of that. People remember it there. Like I don't think people would question if this was $100 stock paying $100 for it because of where it was.
I don't agree with that sentiment, but
Tanner, can I just pause there? Because you just said, I don't think it's worth that. I mean, look, $300, roughly 300 billion market cap, $70, 70 billion market cap. Where is the lot? Like, what is the thing that you think that it's worth? Like, because that's my problem with PayPal. Like, I'm primarily
the range isn't that
big. Small stuff because there's bigger ROI, like there's a longer runway. Whereas with PayPal, like I'm just trying to see is the play a 2 or a 3x? Like, what is the play?
There was a massive step in management. Okay, I don't think that even at the height of COVID, it was worth $300. The problem is Dan Schulman made grave errors in assuming how large the company was going to grow during COVID, and their outlook, their guidance was so extremely large. Whenever that never actually came to fruition, they got extremely optimistic. Thought that e-commerce, same thing with Shopify, right? They thought e-commerce was going to grow past lockdowns. That's what killed both Shopify and PayPal. Both just extreme optimism. But I do think, like, I'm not one. I don't put a lot of price targets on my positions. I think, okay, it's undervalued. The total addressable market going forward is exciting to me. Management seems to know, or at least I agree with the mission that Analyst is going to go forward, and it's undervalued today. I don't know where it's going to go going forward. I know that I would probably place the stock somewhere in $90 to $100 right now.
I think they were on the top of the hill and they got complacent. And so now all these other competitors are chopping at the bit, which is natural, right? That's what happens. Like you get too confident. It happened to Intel. It happened to a lot of great companies where you get so high up there, you think that you can do no wrong. And then here comes a competitor that's working light with a much more pronounced goal. They're not celebrating their stock price. They're celebrating their actual victory and success. So, I mean, yeah, it just leaves the door open for a lot of competitors. And the competitors came in, Cash App came in and ate a lot of market share. You got Zelle that came in, they did stuff onto it. So I don't 5 years ago, I don't think anyone used anything outside of PayPal. I think PayPal had a near monopoly over payments like that, especially over the internet and everything else. I'm not so sure that they are in the same monopolistic position as they were in the past. So they don't deserve that kind of valuation.
How can you not look at it from the Meta standpoint in a similar mind space of, okay, at one point they own this market?
I could see it. I could see the Meta argument saying that, hey, this is something that if they turn the spigot on, they could recover. The problem is Meta doesn't have any competitors, like true competitors outside of maybe TikTok, and TikTok's growth is slowing down. I'm seeing a ton of competition against PayPal. That's the difference. Like Meta went down in stock price, but there were no competitors out there that were eating market share from Meta. Meta still had 3 billion monthly active users. With PayPal.
Two different things.
Yeah, but the same thing is happening with PayPal. They're not losing customers.
But PayPal doesn't have more than a third of the globe using its products on a monthly basis.
I'm not saying it should be valued where Meta is valued.
Somebody who is spending money the way that many prominent people did not want them to, and they didn't have the legal battles that Meta had. Meta cleared a lot of it up, and look what happened with the stock price.
Yeah, and Tanner, this is not to say that PayPal can't double or even get back to where it is. It's just they have a lot more of an uphill battle than something like Meta, which Meta was able to just turn off a spigot, basically just lay people off. Their profitability went up like crazy, and then they just started making money. I don't know if PayPal has those same levers that they could just pull and say, you know what, we're going to just hire less people. We're just going to fire the people we have, and our net income will get boosted up. And then, and then all of our competitors will die. They're going to have to compete. And anytime you're competing competition breeds. Unfortunately, competition is the word. Like if you ever read 0 to 1, it discusses there very openly. Like competition is horrible. If PayPal kept their market dominant position and never let a competitor come through, they would be at $300, maybe even $500. But they dropped the ball, and now the competitors are at your door. The barbarians are at the gates. Now you got to fight them off. So it's going to take 10 times more effort to fight the barbarians off than it would have been easy if you just gone out the castle once in a while and took them out while they were grouping up.
But here's my thing. I don't think payments is a monopolistic business. It was in 2001 when they developed it. But what would they have done to stop Zelle or Cash App or any of these other guys?
Well, that's the key, right? That's what management is supposed to do, whether that be through advertising, maybe that's through providing consumers with a better experience so that this way no one even considers switching out of the PayPal ecosystem.
I completely agree with you. I think in before Dan Schulman in 2015, they even said it, they were not innovating on their products at all. They were just trying to do global expansion and get new customers, and weren't actually building out the product. Dan Schulman came up and broke the company into a bunch of different segments, said, okay, it's time to re-innovate this product. But then they, like you saw, they rebranded PayPal with this whole new logo, this whole new idea that they were going to come out with new products, savings accounts, interest, cards, everything. So they, they broke this company down into 3 main segments, and now they're actually starting to have, not starting, I mean, they've been doing this for since 2017, but global expansion still needs to happen. For example, the PayPal that you guys have in the States is not the PayPal that we have in Canada. We don't have the APYs and the cards with MasterCard and everything like this. It's just not a possibility. And there are things like Chris said, I wish, how come they did not actually build a payment rail? You don't think PayPal's large enough to build, to make a competitor versus Visa? You know what I mean?
They got complacent.
No, I agree. I'm not saying they're the dominant figure that they once were, but I'm saying this is now placed as an like. I believe the stock. I'm not saying the company is my favorite. I'm saying the stock is my favorite. like it's now just too cheap, you know, for
So-
me to not buy shares. The same way that
So-
I'm not the ultra fan
So
of Meta,
Tevis-
but it does get cheap enough.
So Tevis, I want to go back to your question because I don't think it was answered. The way that I would answer your question is, what price are you willing to pay for a company's free cash flow or net income or EBITDA, whatever you want to use as the metric?
That's not how I look at it, right? I'm not looking at it from a purely value perspective. I'm looking at it in terms of what is their runway and what is my confidence level that they can hit or capture a majority of that runway. Like, for example, let's say you and Tanner own PayPal. For me, it's more binary than the level of nuance that you guys put on. It's saying, well, does PayPal have a longer or a shorter runway in terms of what they can return me as an investor than SoFi would, let's say? Does PayPal have a higher or lower likelihood that they can actually achieve that valuation? And then for me to say, well, if PayPal, maybe I can get a 2x or maybe I can get a 3x in the same amount of time, where at SoFi I can get a 5x for marginally higher, risk. If the company is still executing, then why wouldn't I just put my money there instead of PayPal?
But
Yeah,
I don't
so
think
that's
that's
a
fair. I don't think
different-
it is marginal risk. I think it's high risk.
That's
Sure,
a
but
different way than I look at things. I mean, if you're just looking for a percentage on capital appreciation and it's where do I get the most bang for the buck, it's a different philosophy that I would use. And
Like SoFi is the only stock the only financial stock that I own, right? And I'm not owning 3 or 5 or 7 different stocks in the sector. I'm not having a basket. I'm just picking one stock that I like in that sector, and that's where I'm putting my chips behind.
so,
Yeah, but
so
that
then I would
position,
look
though,
at it as SoFi hasn't had their explosive earnings or generation of billions of profits. So from that aspect, SoFi is a lot more attractive as a prospect for generating capital appreciation, where PayPal's been there, done that, and now they need to show the market again and reestablish confidence.
Exactly.
I think for users, this is another thing that I think people are not giving a lot of favor to. The users are not using PayPal as a peer-to-peer payment system. They use that for Venmo, which is still the largest one in America, okay, which is also owned by PayPal. And then on the enterprise side, they do want PayPal. They want the trusted brand, everything like this. So either they're going to use PayPal checkout for the trusted brand for small businesses and keep the margins high, or they're going to use the exact same service that PayPal has, but unbrand it through Braintree. Now, it's hard to see how, Braintree is everywhere right now, but this is a massive company, the size of Adyen, that is growing 30% year over year, and it's unbranded, so no one actually sees that it is PayPal. So the total payment volume of PayPal continues to climb. They are a growing company, while redistributing back to shareholders. And I do think it's a much safer play than SoFi, for example. Not in terms of capital appreciation. I think that probably SoFi takes the cake, but I don't think that you can call it marginal risk. I think it is high risk. The stock went from $25 down to $5. That's a high risk company.
So, okay, let's just put it, okay. So you're investing in PayPal for the capital preservation to some degree, or you're accepting a slower growth rate to have a smoother path, and then you're investing a portion of your money in SoFi where they have a riskier growth rate, but they have, let's say, a rockier path to get there, or it's more precarious or unsure.
Yeah,
Doesn't
it's why
that
people.
net
It's
you-
why it's why people do a split in their investments of some bonds and some equity. I mean, I think it's so then you can weather all environments.
I
Sure,
would
but doesn't
classify
that-
PayPal as a safer speculative play to generate capital appreciation. I mean, I own a lot of different stocks, and across my growth or where I want to see capital appreciation, that basket of it, I probably have 15 companies or so, and I diversified. I mean, I got Amazon, Meta, Apple, Alphabet, SoFi, Palantir. I mean, I have a lot of different tech companies. I don't segment into just one or two because you never know what's going to hit when.
I'm gonna just echo something that I'm gonna say his name because he's a smart guy. Futbucker.
You should be proud to say his name. You gotta be proud.
He needs to change
Man, you're
that
saying
name.
him on the FinTech Weekly,
And this is what I like. Futbucker cuts through all the bullshit, and I agree with the sentiment. He said, "Tech banks are where tech was in November." So right now, I am diversified in my bank holdings, but I think right now the banking sector is a very underappreciated, undervalued part of the economy. So I actually have reduced down my expectations and some of my growthier positions in growth big tech, which I think the valuations have climbed way beyond what was normal for their usual trading range to the banking sector. And that's the one thing, Tevis, I hope you eventually realize that it's not just about picking one company, but also about picking an entire sector that could be undervalued and then finding the gold mines between those. Because what happens is a lot of times the market will throw out good companies with an entire sector. And if you're smart enough, you can pick out some of those good companies, dude, you will do excellent.
So basically,
Excellent.
you're saying SoFi could be a great company, but still be at $5 by the end of the year, just because the market is the market. Whereas some of the other regionals could climb back to normal.
Yeah, because they just have to perform. They just have to perform baseline, and they'll be back to where they were. SoFi has to perform. Yeah,
Chris, by saying picking a sector, don't you?
Hold on, Stephen. Let Tevis go. You got it.
Yeah, I just want to clarify by saying and I agree with the sentiment absolutely, but by picking a sector, aren't you just implying that the strategy is swing trading in and out? Because the market's going to be cyclical. Like fintech or banking is going to be hated today, let's say, or oversold today, and then it's going to be overbought 6 months from now, and then another So like, don't you have to always go in and out? Like, how does that work?
No. So that's the thing. Like, especially if you're looking long term, banking is one of the best areas that you could be in long term because banks pay out really good dividends. So if you buy a stock at a very low price, you're not only banking on the capital appreciation, but you're also banking on the growth that you're going to get from the dividend appreciation also. So like, imagine right now, 2008, 2009, you bought Bank of America or JP Morgan. You could have bought them at literally
Bank of America was trading like
$7 a share. And you would have, not only would you got the capital appreciation for those next 10 years, every year Bank of America would have been paying you to be a shareholder. And that yield would have been close, like right now, based on that share price, is close to maybe like 15, 20% per year. Wealthy individuals, they find where the target is, they go for that area, and then they just hold, and they hold forever. Like, I plan on holding a lot of these banks for 10 years plus because I know the yield right now, I'm getting a 7.5%, 8% yield on a company that's generating a ton of free cash flow, right? And their free cash flow is growing every year. I'm looking at a 10 years worth of not just capital appreciation, but dividend appreciation also. So like I said, I think you have to be sector dependent, but there are times where the sectors become very overvalued and you should be ready to cut some too. Like when growth big tech, they were like when Tesla hit $300 something, right? If you didn't sell, I don't know what to tell you. Sometimes you have to be smart and say, you know what? Let me trim a little bit off the top. Being a good investor, think about it this way. Warren Buffett. Does Warren Buffett just hold and buy a company forever? Or does he trim positions once in a while and go into different positions after a while too? Warren Buffett is buying up banks right now. Michael Burry buying up banks. Bill Gross buying up banks. Every single whale is buying up banks right now. So all I'm saying to you is just think about it. The sector itself is undervalued. So right now, in my opinion, you could take a dart and throw it at a dartboard that had nothing but financial names on it, and you'll still do better than the general market. If you just invested in the thing, because there's a lot more price appreciation that's going to come once these rates start to go down. So I would say in a year now, look at the index fund, look at the indexes in the financial side and the banks. Most of them will have recovered back to their mean again, and by that time, just master the market cycle. Howard Marks, read some Howard Marks. You'll love it.
And look, banking is a requirement for the economy. It's never going away. The winners will change here and there, but I've been trying to sell Chris on one. I'm going to say right now, Citigroup. I mean, I called it before Buffett bought it, like a week before. Somehow I got lucky on that.
I did.
one.
I bought some Citigroup because
See?
Steven mentioned it. Yeah, the price to book, price to EV
It's
is
crazy.
just too good.
So
Yeah.
you can grab a 4.5% dividend yield with them. They are a top 4 money center in the country, and their tangible book value, which is stricter because it strips out goodwill and the intangible assets, is $84.34. Their book value is $96.60. It's trading at $45.71. I mean, this thing just has not recovered yet.
Tevis, the banks are selling dollars right now for pennies. That's they're saying, here is $1. Please buy this dollar for me for 60 cents. Like if someone came to you and said, hey, Tevis, I have $100 bill, but I'll sell it to you for $60. Would you buy it? Yes. Think about it.
And
that is
nothing
what you're
against
getting
the
with the banks
regionals,
right now.
because I own 2 regionals right now, but Citigroup's a big 4. I mean, it's not going. Yes, it could go somewhere, but the probability of it going somewhere is very slim.
I think for me personally, you know what, the unknown for some of those banks like Citigroup, for example, I don't necessarily know why it's trading so cheap. Like for example, on a price to book ratio, and then that would require a lot of, work for me to find out. So if there was an ETF for me to buy banks, then maybe I'd be more interested. But individually picking them, I'd have to do a lot of work. And right now, I just don't even have for me, I'm already in,
KRE. You could just buy KRE. KRE is the regional bank.
That might be a
ETF.
better idea just personally, but I wouldn't even know the risks for why Citigroup is trading so cheap. And if something is trading so cheap, you can't just think that the market is delusional and you found something great. I mean, there must be reasons for valuations.
Well, the reasons were because two big banks collapsed and the market got stupid and threw the entire sector away.
That's not true. Citigroup has been.
So you think if Silicon Valley Bank did not collapse, everything, the banks wouldn't be down as much?
No, you're not listening. No, yeah, Citigroup has been trading for half or 0.5 price to book forever, for years.
Well, I'm not
and
talking
years.
about Citigroup. I'm talking about some others. But
But I'm talking about Citigroup specifically. If you're buying individual names, you have to look at them individually.
Yes, that is correct. That is correct.
One of the things that it's arguably the most important metric when you look at their balance sheets is their LDR ratio, which is their loans to deposits. Citigroup's is phenomenal. They have 1.3 trillion in deposits, and their loan book 634 billion. I mean, they are very liquid.
But unless you can articulate the actual bear case for why it's trading so cheaply, then you're missing something.
Yeah, I probably am.
Sometimes
Mr.
Market gets drunk. Mr. Market gets drunk.
I agree, but that wouldn't be my first assumption.
Did not make sense when it was at $90.
Yeah.
Yeah, no, I agree with you. The market can be dumb. I agree, but that would not be my first assumption. If I've done a lot of due diligence, then I go, okay, you know what? Then it's being dumb. But I think that's how you get caught with your pants down.
Tanner, I used to be like you a little bit in that I would try to find the reason why something is down so much that I would scare myself away from an industry. And then I realized people are stupid and human psychology just works. Human psychology is the biggest detriment to good investing. So if you just right now, when there's fear in the market, people will sell things at irrational prices. And that's just how it is. And this is like time immemorial. I'm telling you, just if you look at Buffett, one of the things that Buffett always says, when things are stupid, you should be a buyer. But when things go stupid, people are like, maybe Buffett was wrong after all. And then they miss out on exponential gains. So that's
I think there's so many countless examples that go against that, though. Like, it would be hard to play the market. Like, who would know that going into COVID that a luxury car seller like Tesla would have hit all-time highs? That doesn't sound like that adds up. You know what I mean? We're going into a recession due to forced lockdowns. Who thinks that luxury electric car?
But it's not that hard to put together stimulus payments and interest rates going sub-zero. It leads to a bunch of liquidity, so growth stocks go up. You don't have to be a genius to figure that out.
You didn't even need to get Tesla. You could have just got Moderna, which is the most no-brainer thing, and even that got you stupid returns over such a short period.
No, I agree. But I'm saying market sentiment. If you were to just blankly think about, okay, everyone's stuck at home. Why do you need to drive anywhere? We have no money. why would we buy luxury cars? Tesla sounds like a bad investment if you're going off of market psychology. It wasn't. It was the greatest investment of the practically the COVID.
But Tanner, every single stock went down 30-40% during COVID. That 1 month in March, if you guys remember, everything was down 70%. There were companies that were selling at I bought Oak Tree Specialty Lending. Okay, they have a ton of first lien debt. They were trading at $3 a share with a net asset value of $8 at the time. It made no freaking sense whatsoever. So in my process of trying to question it, I ended up losing out on some potential gains because I was like, man, what if the bottom falls out? What if dude, sometimes the market is stupid. Enjoy
I think it's a different philosophy in investing. Like I just like to I definitely do some market sentiment based on like brand and stuff like this. Like I'm a big believer in Airbnb or even Nubank. Does the valuation actually fit Nubank right now? I mean, I think it's expensive, but you also have to know Nubank.
But me and their growth is freaking phenomenal, and they're growing like crazy. Yeah.
But yeah, I like to look at the numbers more than I don't even know what you'd call it. Timing the market is what it feels like.
Let's just go back to the bank conversation. Steven, it sounds like your favorite bank right now is Citi. Is that so? I just want to hear I know Chris, Steve and Chris. Like, if you had to say, what is your top bank right now?
And thank you, Eric Jeans, for the $10 super chat. Great conversations. Appreciate the weekly videos.
I want to share.
Yeah. Go ahead.
Chris, go ahead, because I want to share my screen when you're done.
Yeah, mine is Truist Bank. Truist Bank, they're like the 6th largest bank in the country, even though everyone's like, oh, this is a regional bank. They have an insurance business that's like the 6th largest insurance company in the United States. They do primarily small business and small clients. They're like everywhere you go down south, you're going to see a Truist Bank because they're a merger between SunTrust and BB&T, who are down here. They have a ton of revenue streams. They provide all sorts of products, whether that be credit cards, home loans, you name it, they're in it. So they're very well diversified. They're not your First Republic banks, which only cater to a small subset of the population, or Silicon Valley that only, did it with one specific sector. They're a very diversified bank. And anytime I say the name Truist to people, they don't know it because Truist is actually a brand new name. But they are an old bank. They're from like the 1800s. Okay, that's how far back this bank goes, and their price to book is in the 60.60. Their PE is a 6, which typically banks trade at a PE of about 10. So there's a lot of upside. That's literally, it's just all you need is Mr. Market to wake back up, and everyone's gonna be like, wait a second, why didn't I buy this when it was undervalued? That's it.
All right, I want to share my screen very quickly, so just give me 1 sec. Can you guys see this?
Yep.
All right, so these are the big 4: Bank of America, Wells, JP Morgan, and Citigroup. I mean, JP Morgan and Citigroup have the same exact LDR ratio. Lower's better. Equity to market cap. Citigroup has over 2x the equity on its balance sheet than its current market cap. And Citi's the only one that trades at a discount to tangible book value. And it trades at a very large discount to regular book value.
But this doesn't send you warning signs? Because this is just red flag central to me.
How is this? The only way that it's red flag central is if you think that assets are worth pennies on the dollar.
No, I think for these easy metrics, every single institutional buyer in the world is looking at the charts that you're looking at and better. Okay,
so
it's such a clear indicator that Citigroup is not like the others. That is across the board. Sorry if Steven's gone, but I'm going to continue for a second. But all I'm saying is,
I know what happened. He probably
Sorry?
tried to take down the chart, and he just closed the whole window.
Yeah, exactly. He just left.
I know that's what happened.
This is Stever's boomerness coming out. It's like,
he clicked the one red button.
Sorry, Tanner, go ahead.
No. But all I'm going to say is that if I know Warren Buffett just made a
You figured out how to use a computer, huh?
You know what? I'm buying a freaking camera. I'm mounting it on my fucking wall, and I'm using my main computer, not a stupid laptop for this stuff. I have a 49-inch monitor in front of me where I can put everything nicely, and I'm using a
You
laptop.
literally have to press one button, and you would have everything.
Yeah.
Would have
And,
been
and
No
by
idea
the
how
way,
many things I have
and by
on
the
the
way,
thing.
to that one viewer who recognized that I got a new mic, thank you. I love.
Oh,
this
it's
mic.
there. The sure is. I didn't even see it.
Yeah. Yep.
Oh wow.
Dude, this mic is amazing. Like I
He's
tested
a
it
real
yesterday.
podcaster now.
Cheers,
Wait, so
man.
are three of you are on the same mic now? Fuck.
Yes.
Yes,
I
sir.
Look at you
But I
guys.
sound the
What's-
sexiest out of all of them. So.
Tevis, what do you have?
Well, I'm traveling, so I have just a little lapel mic
And-
right here.
okay.
But
I've
normally I
told
have the
Steven-
shitty Yeti.
I've told Steven multiple times that the Yeti, the top is not actually where the audio is recorded. It's at the front for the Yeti, but he keeps pointing it at his face.
What's the front? Where's
That,
the front?
like that. No, okay. First of all, okay, you have
That's
it.
the
You
back.
have it turned around.
Okay. Well, look, I don't know these things. What do you want from me?
So
This is
definitely
how
get
Steven
banking
talks on
advice
the
from
phone.
Steven.
This is how Steven
Definitely
talks
get
on the
banking
phone.
Yeah, definitely get banking advice from Steven, but don't get advice on picking on Mike. Definitely.
Dude,
No,
I
definitely not.
I know you're in all the value stocks just from the last 2 minutes of seeing how you handle technology.
Yeah.
No, he has a bunch of growth. All right, guys, we
Well,
got to
yeah,
end this.
to
We got
answer your
Palantir
question-
Weekly.
Wait, real
coming up.
quick.
Go ahead.
All I'm saying is if Warren Buffett, I know he made a small purchase in Citigroup because he's willing to take the risk, but if anyone could look at screeners like that and make easy bets on this massive discount versus the rest of the banks, he would have acquired 10% of Citi like that. There's red flags
No.
hidden within that
No,
company.
he
whether
won't
it's-
do that. He won't
He
do that.
said that he won't do that for numerous reasons.
Yeah.
like why?
Because he's not a bank holding company. He can't even go past 10% without raising.
He can hold 10% of a bank. He's done it with Bank of America and
No, 9.9 something percent. He doesn't go beyond
actually,
that.
that's not true. He actually
on.
got a request to hold more than 10% of Bank of America, and he went up to 13% at one point. So actually, he's held more than 10%. 100%. I'll send you the article right now.
All right, I gotta look that up. Yeah.
But absolutely, he can acquire up to 10% and not be a bank holding company. And he didn't. And no other institution. You're not seeing Bridgewater or any of these companies that would love to hold banks touch Citigroup. Why is that?
Believe it or not, you're asking the right questions. I'll definitely have to take a second look. Sorry,
I'll look
Steven.
more-
Sorry,
yeah, I'll
Steven.
look-
I'm gonna take a second look. I'm never one to look. I'm never one to ever. If someone brings up a valid thing, I will definitely
valid.
look at it. And
You're making
and
Tanner have an
readjust my
orgasm right
valuation.
now because you said he had a valid point.
No, I mean, look,
He just
Tanner
turns
has a
up.
thesis. Tanner has a thesis, and if I can't break his thesis on the air, then I should really evaluate. You
The
know,
only
like I
thing
can't
that I
break his
know-
thesis.
The only
Yeah.
thing that I know about Citigroup for why they're more discounted than other banks is that they hold insane amounts of what do you call it? Institutional lending products. That's the only thing I know is that they have a lot. Or sorry, did I say institutional? I meant to say international lending, and supposedly that might be more risky. I mean, obviously, but
I'll look into it this week. But to answer Tevis's question, it's not one favorite. Let's exclude SoFi because they are a bank. Excluding them, it's three that are my main. New York Community Bank, which is already run quite a bit. Citigroup, Bank of America, and now TFC. I looked into it after Chris recommended it, and it's, my opinion, very solid.
I'm actually buying Zion Bank. The Mormon Church has had long-standing relationships with Zion Bank. They launder all their money through. I mean, I don't want to say launder. Sorry, wrong word. They pass a lot of their money through that bank. And the one thing I know is their Mormon Church is very well capitalized. So I don't think they're going anywhere.
didn't
Sorry,
they just
I didn't
get
mean
caught
to-
with
I
a
didn't-
large sum of money or something?
Hey, that's the whole point. Who's more well capitalized than Mormon Bank? $100 billion in assets. That money's swimming in around Zion National Bank. So I'm all for it. Okay.
All right, time for Palantir.
Time for Palantir. Steve, I don't know if you want to be on, but if you want to be on, no, you're busy. Okay, you don't have to.
No, I need to finish this article, and I
All
missed a TV show, so I need to catch up.
You got to catch up
TV
on your
stuff.
fucking TV. All right.
Obligations.
Steve,
Thank you, everybody. We'll be back
I'd
next
love
week.
to learn some tips. All right,
Stay on, Tanner. Hold on.
all right, I will.
Bye, everybody.
See y'all.
Bye,
Good
guys.
night.
Can you take the live off? How do we do that?
Is it still live?
It's still live.
I don't think I can, but this is quite
I didn't end. I didn't end it.
Okay,
yeah,
end
you
it.
did not. Can you take the live
Okay,
off?
I'm ending it now. No.
Bye, guys.